some of the high-flying IPOs, some of the highest of high multiple tech stocks that have just absolutely ripped. Where is the area that our viewers need to keep most in tune with?
I would say yes to all of the above, Scott. I think you make a really good point. I mean, they've been a great run, right? We've talked about this time and time again, but we look at these multiples, and you don't have multiples in some cases, and so we have to price these stocks in a completely different way. Well, I don't know how healthy that is, so I think that it makes a very big difference in how you're determining where you want to have your investments. And obviously, if you want to have high-risk investments out there, sure, there are some great opportunities like this. But I think at the same time, you have to understand, if you're in that world and you want to be in those kinds of names that you just mentioned with these unbelievable multiples, if they've got multiples and all of the rest, you're basically looking for whatever you'd consider to be sort of like a hope of some sort that this can continue and someday maybe grow into it. Other than that, you've got some high risk. There's no doubt in my mind. And I think there are better places to be, Scott, where you've got lower risk, and yet you've still got plenty of reward. Maybe not the same kind of reward as you're seeing in some of these others, but certainly there's been great reward in this market already, just kicking off 2021.
Yeah, Joe, I mean, look, the bottom line is you can't have it both ways, okay? If you want to make an argument that stocks are so compelling, especially these technology stocks that trade at high multiples, and those multiples don't matter because interest rates are so low, if interest rates start to rise, you just can't brush it off and say, well, it doesn't matter because rates are rising for the right reasons, so the multiples are justified where they are. Or am I wrong?
You're not wrong. The way that I would think about it, and the viewers should think about it, is basically the economy and the market is on a 5-on-3 power play in hockey. Got a two-man advantage. You better score as many goals as you possibly can because you can't realistically expect you're going to play the entire game with that 5-on-3 advantage. We're going to return to 5-on-5 hockey at some point and a return to normalcy. And that return to normalcy is going to be rates that, as Josh pointed out, 1.50. That's where the S&P dividend yield is. So you're going to have competition for equities at that point. We could rise even further towards the January 1st, 2020 price for the 10-year Treasury of 192. Why? Because you're seeing a steepening of the yield curve, which is really illuminating this economic optimism. Understand something, Scott. The last time that the 10-year Treasury had a move like this was from 2016 into the end of 2018. We went from 1.50 to 3.25. The yield curve actually flattened at that point. So this time is a little different. You can expect the economic optimism to lead to higher yields. And as I said before, that's when the two men are going to come back on the ice, and a lot of the easy ability to score these goals is going to be removed from the market. That's just reality.
Yeah. Okay, but, you know, unlike a two-man advantage in hockey, and I like your analogy, I'm a hockey guy, I'll run with that, this power play is going to go on for a while. I mean, if you listen to Sarah's interview with Janet Yellen yesterday, the new Treasury Secretary, former Fed chair, it just underscores the fact that she wants to go big on stimulus, Brenda. So, you know, you're going to get likely a large stimulus package. You're reflating the economy. Some of the GDP projections are now just through the roof, and they seem to be ratcheted up by the day. So in that sort of environment, would you want to buy an Apple, you know, and rates going up? In that environment, would you want to buy an Apple or would you want to buy a Deere or a Caterpillar, for example? What's the best place for the money?
Yeah, I think in that sort of environment, obviously everyone's going to benefit from more stimulus. And I think when it comes to Janet Yellen, she's looking and reflecting back on the last cycle and thinking if we had done more, we wouldn't have ended up with a decade of pretty slow economic growth. But I think that's key to why tech worked so well during that time frame is because growth was relatively scarce. But I think as we look forward and suddenly growth won't be as scarce if there's lots more stimulus, that those areas that have been underperforming for the last decade and that would really benefit from faster economic growth, like the Deeres and the Caterpillars, the financials, the industrials, those groups should really be bigger beneficiaries. And if we look at where earnings projections are, even for this year, we can see that energy, financials, industrials, consumers are all projected to grow earnings faster than technology. So I think it's not just a rate story, but it's also an economic growth story that's playing out here. And I think that should support this shift to more cyclical groups working better, I think, than technology, where comparisons are hard. They're going to start getting harder in the first quarter here.